All right, let's go ahead and get started today. Today is, what is it, Wednesday, November 15th, 3:30 section. We are recording here. So thanks for being flexible with today. I got some people joining us from different sections. So here's the deal on a couple of questions that I've been getting. So essentially, the university kind of changed things up, as we heard on Monday, about next week. And so it changed the way we're going to have to do our class on Monday and what I was going to do for the extra credit. So the new plan is as follows. Basically today, we're going to practice and talk through some of the scenarios that will help you do these multiple assignments in class and answer any questions that you have about homework 11, which is still due on Monday, whatever it is, November 20th, okay? I'm going to add a homework 12, okay? Homework 12 will be another multiples assignment, which will be due on Monday the 27th. That is an extra credit assignment. So it'll be worth 2 points, okay? So rather than doing an in-class extra credit on Monday, we'll do an extra homework, which is due the following Monday. Now, because of the university policy of not having a live class, in order to do that multiples assignment, you're going to need data from Bloomberg. So what I'm going to do sometime today or tomorrow is take screenshots, basically the WAC, the EEO, and the guidance of the three companies for homework 12, and I will post them to the assignment, okay? So that way you can actually do the assignment using the screenshots. You just won't actually have to access a Bloomberg terminal, right? And so basically you just have to finish that assignment by Monday, November 27th, by the time you get back from the holidays, right? So that way, this coming Monday, November 20th, we're not going to have any class. So it's up to you. If you can get it done before the weekend, right, then you get a whole week off. If you want to do it on Monday, then you can still do it on Monday. We're not going to have a class on Monday. But regardless, the homework's going to be due on Monday the 12th. Now, it's going to be an extra credit assignment, which practically means that if you don't do homework 12, it won't count against you in terms of opting out of the final exam, okay? But if you are looking for extra credit, it's one of the few extra credit opportunities you're going to get this semester, so I'd strongly encourage you to take advantage of that. And again, the way that the extra credit will work is it's just going to add 2 points to the population universe. So what that means is right now there's 100 total points across all the assignments. After homework 12, the extra credit assignment, there'll be 102 points across all of the assignments, okay? And the 2 points, this is where ELMS will start to confuse you. The 2 points just get added into a final grade. So for example, if you're trying to get an A- this semester, you need 90 total points across all assignments. So the grade on any individual assignment doesn't really matter. It's just points across all assignments. So given the 2 points, you need 90 out of 102 is an A-. 93 out of 102 is an A, okay? So it's not percentage of total, right? That'll confuse you. It's just total points. So I'm adding 2 points. So if you didn't do well on a homework, you didn't do well on a team project, you didn't do well on the midterm exam, and you're looking to get some extra points, homework 12 is the way to do it, okay? That is different than the assignment replacement, right? The assignment replacement will only replace an individual assignment. It won't replace a midterm, and it won't replace a team project, okay? So you can't get any points for the assignment replacement on those, all right? But this 2 points is kind of ubiquitous. It's just 2 extra points added to the semester. So that's going to be homework 12. Call it an optional homework assignment, due the Monday after Thanksgiving. And Monday of Thanksgiving week, we will not have a live class. Make sense? Questions about any of that? All right. But the Monday of Thanksgiving week, which is the 20th, homework 11 is due. Okay, so you do have to finish homework 11 by that day. So please make sure you get that at least done before you head out for your holiday week. All right, so back to assignments. Homework 11, which is due Monday, November 20th, was the multiple analysis of these 3 companies, Ralph Lauren, PVH, VF Corp, right? Before we get into our practice today, any questions about that assignment? what you need to do. You'll basically need to get screenshots, which, again, for the people that are here live today, hopefully you've been able to do that while you're in class. But you'll need screenshots, you'll need the WAC, you'll need the EEOs, you need the guidance or a JP Morgan screenshot for the tax rates, and then you'll need something for the spreads. So you need an operating ROIC. So you can use an RV screen if you think that's reasonable. If you don't, you got to come up with some other way to justify a spread. So you got questions about that? And then you got to write a paper explaining all that. All right, so let's practice two ways. So I want to go back to this file, which I did with my MBA students this summer. Okay, so the data is a few months old, but I still want to talk about again how we analyze. So think about your write-up now. You put the data in. I am trying to write up and explain things. So the first part I want to mention is the first company, three pharmas. We got Merck, AbbVie, and Lilly. I want to talk about Merck. Okay, so in the pharmaceutical industry, all three of these companies are expected to have pretty high spreads going forward. Okay, it's just the nature of the pharmaceutical business, right? And so that is pretty reasonable. So the question then becomes, okay, I think I'm pretty confident they're going to maintain high spreads. That's why they have high ROEs. The real question is, what does it say about the growth? So in order to get Merck's P at the time, which was 13.73, then if we have a really high spread, and you can see this here, if we're trying to solve for this, before we solve for it with zero growth, we have a PE of 17, all right? At the time, with a very high spread, Merck's PE was 14, but with no growth, we get 17. So then the question becomes, okay, how do we actually get the PE lower using the key value driver equation? Well, the answer was, if we solve for G, we get this number. We get a negative G. Okay? So the first thing I just want to talk about is, what would be a reasonable circumstance for a negative G? Okay? What does a negative G represent? So let me ask you, what does a negative G represent in perpetuity? Yeah.
Company will eventually be worth zero.
So you're heading towards zero. So you definitely say the future is going to be worse. But does a negative 2% G suggest they're going bankrupt anytime soon? If a company loses like 2% of its sales or profits every year? It's kind of a long-term heading worse. So that's the point. You have two ways to kind of think about negative G. Now, if you get a really big negative G, then what you're saying is the company's heading to zero pretty fast. All right, so they're probably not going to be around. I don't think that's the case. Everybody thinks about Merck as a pharmaceutical company. So the point about Merck is what I would just say is peak, okay? Because think about it, and I'll try and draw it here in Excel, just because since we're trying to record this, you won't be able to see what's on a whiteboard. If we're trying to represent sort of cash flow over time with the key value driver equation, okay? So the whole point is, what does a typical cash flow look like? If we're here and we have a positive G, what we're really saying is, if this is kind of cash flow over time, we're saying the value of the company will continue to increase over time because they'll generate more and more cash flows. That's kind of a positive G, right? If we're saying it's a negative G, what we're really implying is a line that looks more like this. And what we're saying is they'll still generate cash flow in the future, it just won't be as much as they generate today, right? And so that was actually the case of what's happening with Merck in the real world. Because what's happening with Merck in the real world, and you can actually, not that, Bloomberg. If you look at Merck in the real world, they have a drug, actually two drugs, named Keytruda and Gardasil, which if you look at this kind of consensus estimate, the revenue on these drugs is growing pretty substantially. So for example, Keytruda last year was 25 billion in revenue for just that one drug. All right, it's now the biggest selling drug in the world, and it cures cancer. Like that's what it does. Right, so it's a very powerful drug. It's a very expensive drug. Costs $100,000 a treatment. Right, but if you have cancer, like you want this drug. Now, for some of the cancers, for lung cancer, for example, it only works on a third of the people with lung cancer. So if you're in the 2/3 that it doesn't work on, I feel badly for you. But if there's the 1/3 that it does work on, it will save your life. Okay, and it will actually get rid of the cancer. So that's why it's been a very powerful drug. It's changing. It's called immunotherapy. It uses your own immune system to fight the cancer. And Merck is actually not just doing lungs, they're doing all sorts of cancers that it's targeting, novel treatments. So this drug has been a runaway success. This drug, which is 25 billion a year in revenue, is expected to grow to 34 billion in revenue per year for just that one drug starting in 2027. Right? And they have another drug called Gardasil, which is going to go to about 12 billion. These two drugs will represent 36 and 12. They'll represent just those two drugs almost $48 billion worth of revenue. Okay? But, and unfortunately there's always a but, 2028. In 2028, the patent for these drugs expires. So what do you think is going to happen to Keytruda sales in 2029? What happens to a drug when the patent expires? Yeah.
Basically, it loses the monopoly, so all other companies.
So now there's lots of monopoly, and then what's going to happen to its sales?
Sales are going to decrease because now there's more competition and more companies are producing the same thing.
Yeah, there's now what are called generics and what are called biosimilars are now there. They can have competition. There's now choice. Prices plummet. Typically, when a drug goes on generic, it loses 60 to 70% of its revenue. Okay, that's pretty typical in the pharmaceutical industry. So that's the point. Like, when I try and model this out over the long term for Merck, I'm going to have, and you can see the numbers here, I'm going to have 30 billion, 32 billion, 38 billion, or sorry, 33.8 billion, maybe 35 billion, I'm at 12 billion. All right, and then 10 billion, and then maybe 8 billion. And that's what's going to be my forecast for Merck. So the point is, if I look at Merck today, which is at 25 billion, how do I represent that cash flow over a long period of time? That's the negative G. Okay, so the point of the negative G is just saying it's not that Merck's going away. It's just that these are the good old days. These are the best of times for Merck in the next few years, but the market doesn't expect anything in the long term to replace it. And they actually see less long-term sales than the current sales because this blockbuster is probably not going to be replaced by something else this big. And so therefore their longer term cash flows will start to decline. Right? And I say that because if we're trying to explain a negative G for a company in our 500-word write-ups, that's what we would be saying about Merck. Okay? But it would have taken a little bit of look into a BICO or something else, an analyst report, to figure it out. But I'm just telling you, if you go to Merck's BICO, and you see what the analysts are talking about today, right there, what's the summary say? Merck's continued success with cancer drug Keytruda has increased expectations, is storing up daunting future when the patent expires in 2028. And then Keytruda is at that point 44% of sales. And then what's going to happen when they hit that patent cliff? So I'm just telling you, it's 2023, and the analysts are fretting about 2028 with Merck. And the whole point is, there's nothing Merck has done that's telling the market that they have anything today that's going to replace that much lost sales. So when you think about how that plays in the context of their PE, yes, Merck, a pharmaceutical firm like many others, gets really high returns in their drugs. Yes, they have some growth in the next few years, but that growth's going to quickly go away. That's the reason for the negative G. It's not that Merck's going bankrupt. It's not that Merck's going away. It's just that the future is actually going to be less profitable than the next few years. And when I'm doing a perpetuity, if I'm drawing a line that balances the two out, that's that slightly negative G. That's why the PE for Merck is lower. Okay. Now the converse of this is Lilly. okay, which we're about to talk about. What's happening with Lilly in the pharmaceutical industry is slightly different. Because Lilly ODL, if I look at their multi-periods, including forecast by drug, this is again revenue by drug, you see that Lilly sales, which were 28 billion last year, are exploding and doubling in size to more than 64 billion. And when you see what's going on with Lilly, you see a drug called Mounjaro, which last year had $480 million worth of sales, and by 2027 is expected to have $15 billion worth of sales. Does anybody know what Mounjaro does? Yeah.
It helps weight loss.
Yeah, it's basically their version of Ozempic. It's the weight loss drug, right? And so Lilly has two drugs. One is called Mounjaro, and actually they just came out, the FDA just approved another one, which is basically Mounjaro higher dose. And those two drugs together are going to have a huge amount of sales, right? By 2027, 2028, we're talking about $50 billion a year for 4 weight loss drugs, right? The other two drugs that sell a lot in weight loss are a company called Novo Nordisk, has 2 drugs. One's called Ozempic, okay, which was originally for type 2 diabetes, but it has weight loss. People that take it lose about 20 to 30% of their weight, so huge weight loss benefits. And they have a higher dosed version of Ozempic called Wegovy, I think is what it's called. But the point is, Ozempic and Wegovy are the same exact drug. The only difference is you pay more for a higher dose, and they renamed it, okay? But Lilly has the same thing, all right? Lilly's version of Ozempic is called Mounjaro, and now that the FDA is allowing it, they have a second drug, which I forgot what the new name is gonna be, but basically, it's the higher dose Mounjaro, all right? Which is really this thing called tirzepatide, okay, it's the actual drug. But here's the point, they have a patent on it, just like Novo Nordisk has a patent on it, and they're still in the early stages. So when you look at their cash flows today, Mounjaro's not peaked, right? For Keytruda's already a $25 billion drug, growing to 30 and then going off a cliff. Mounjaro is a $500 million drug, going to at least 15 billion and beyond before its patent cliff starts to head it down. So what I'm saying is, this is a key driver to Lilly's sales growth. So when we look at their G, Lilly's G of 5% that we're going to actually solve for with their high spread is looking more like this line to represent the perpetuity period, right? Because they're still early innings with a lot of growth. Merck is later innings, which is peaking maturity going into slight decline. So that's the difference in why you're seeing a higher G for Lilly than for Merck. It's just math behind this, but I'm trying to explain the concepts behind the math. Does that make sense to everybody? Okay, so just a couple of things that, this is why I go back to when we come up with multiples. Multiples are an expression of growth and spread. That's all they are. What growth and spread represents is cash flow, right? Because ROIC is a proxy for free cash flow, and G is a proxy for how fast that free cash flow grows, and then the WACC is just how much you discount that free cash flow. So that's all the multiples are. They're just an expression of future growth and future spread. So what we're trying to represent is the cash flow that ultimately represents is the long-term value of the firm. That's here, okay? It's this line, row 7, right? But nonetheless, what's going to drive that cash flow value is the growth and the spread. So we're just trying to explain what growth and spread leads to that cash flow. That's kind of what we're just doing in a multiple analysis. It's short-circuiting a DCF. So the DCF, we basically forecast it out 5 years. Then year 6, we're trying to do a continuing value to represent the rest of the value. When you do a multiple analysis, you don't do the first 5 years. You just start from today into perpetuity, represent the entire value of the firm. Okay, so it's similar to a DCF analysis. We're just shortcutting it to now to represent forever, and we're shortcutting it to 3 values rather than all the different values we're forecasting in our DCF. So it's a simplified version of a DCF, but it's still based on DCF principles. Get your hand up.
Yeah, I was just wondering for like, in an industry like pharmacy, where it seems the growth rate is so variable, because it's based on like the patents and stuff, is it even a reliable metric to use? Like,
To what to use?
that's like
The G?
using G to project like cash flow and stuff. It's
Well,
variable.
there's two answers to that question, which is there is some variability in pharmaceuticals, but we kind of know what the patents are, and we know which drugs are under patent. And while they're under patent, we have a pretty good idea what the sales and margins are going to be. So that part is actually fairly predictable, right? And we kind of know what happens when they go off patent. So it is actually fairly predictable when they go generic. The problem with pharmaceutical firms is what comes next. The real uncertainty is what comes out of their pipeline, because there's just a lot of uncertainty in early stage drug development, and most drugs never make it. So that's the harder part and the more enigma of the pharmaceutical firms, is what happens to the early stage pipeline, and does it lead to the big drugs? Because I'll tell you that, take the drug I just told you about, Keytruda, which cures cancer. Like, Merck actually did not develop that in a research lab. Merck bought another company a decade ago. Who did they buy? Forgot their name now, getting old. But they bought another company who had this drug, and it was sitting on a shelf, and they weren't doing much with it. And so the research scientists were like, hey, Merck, I know you're our new owners. We actually think this drug over here could have some serious benefits for oncology. And then they kind of turned it into the world's greatest selling drug. So it was not a plan. Like, there wasn't a plan for this drug. It was an accident. And that happens a lot in the pharmaceutical industry. I mean, kind of jokingly, but a number of years ago, I think I might have told you this, but I worked with a company called Lilly, and one of their big drugs at the time was called Prozac. And Prozac was one of the first mental health drugs to help people that had some challenges, because it started helping with chemical imbalances, because we didn't think the chemical imbalances had anything to do with mental health, but it did. But here's what was interesting. That drug, which started the whole mental health drug part of Prozac, was an animal health drug that didn't work on animals. And so basically, it was a failure for animal health, but it turns out it really helped people. Right? Now, they don't talk about how they went from animal health to humans. That part they kind of skip over in the story of Prozac, but that was the point. It was a complete accident. It was never meant for humans, right? But it turned out to be a game changer in the mental health industry. Another drug that was a complete and pure accident was Viagra. Viagra was actually not meant for erectile dysfunction. Viagra was actually developed for heart patients. It was a way to help blood flow to the heart, right? And then it had side effects, right? And basically, people started to realize that the side effects were more important to people than the actual drug helping the heart patient, because with all the blood flow, it changed mental or ED. And so that was the point. Like, it was never meant to be the ED drug. It was actually meant to be for heart patients, but it was an accident. And so that's the problem with R&D development with these pharmaceutical companies, is a lot of what they do is serendipity. And predicting serendipity is actually not so easy. So that's the enigma that makes it harder to value these companies. But once the drugs actually get approved, it becomes much more straightforward on what they're going to sell. And that's the easier part of valuing a pharmaceutical company. Yes?
So you did this, you conducted this group like this summer, right?
We did this, I think, in August 2023.
If you did it today, do you think the growth will still be negative after they just did that like?
That's a great question. So let's do Merck today. Let's update this through today. And I'm just going to look at their price to earnings multiple, because that's real easy to do. So what has changed about Merck? Well, the first thing that's changed is the cost of equity is probably higher, because interest rates have been continuing to go higher since the summer. So right now, their cost of equity is 7.2%, whereas the summer, it was 5.9. So let's update this to 7.2. Okay. Second, if I go to the EEO, Merck's PE is probably different. And today, Merck's PE, second forward year, is 11.94. A little bit higher, but not much. Oh, sorry, did the wrong one. It went down, 11.94. Okay, and the other element of this is the earnings for 2024, 21.436 billion. That hasn't changed all that much. And the expected return on equity, it's probably gone up. 48, 43, 39. It's probably closer to 40% now. Can't type in 40. So let's put growth at 0 before we solve for growth. So here's the point. You put those numbers in before you solve for a G, and you're looking at a PE, same as earlier, 16, 17, 15, 16, 17. And their PE has actually fallen to 11. So then the question is, how do you explain an even lower PE? Because it means probably a slightly bigger negative G. Right? So it's going to be probably more negative than it was a few months ago. Right? And I give you a reason why, based on the data we just looked at. Does you remember what the return on equity was before I changed it to 40? They were in the 30s, right? And now I changed it to 40. The reason I changed it to 40 is because since this summer, these return on equities have gone up. They were mid-30s 3 months ago. Now they're mid-40s, mid to high 40s, right? And the profits have gone up. So even in the last 3 months, people have actually had a better view of how much cash in the medium term Merck is going to earn. But it doesn't change the fact there's still a cliff in 2028. So they just have a higher cliff to go down.
Because 2 weeks ago they just bought 3 ADCs
Okay?
for like $22 billion. And they're thinking this is going to be like, this is going to, balance Keytruda because they think, ADC is the future in cancer and not immunotherapy.
So let's go to the M&A database.
So I'm surprised now,
And
I don't think it's going to grow.
if we look at Merck in the M&A database, I think what you're looking for is, you're talking about Prometheus?
No. They acquired ADCs from Daiichi Sankyo. Like just the drug itself.
Okay, so they didn't buy a company.
No.
Okay, so they acquired what drug again?
It's the antibody drug conjugates.
Okay, and that's supposed to be what?
The future in oncology.
Okay, and it's early stage though, right?
Yes.
So there's not any drugs that are being developed with it, it's just the technology to develop that drug.
Yeah, it's a drug.
So we're talking 8-10 years before it comes to market. There's the issue. Like if they're doing really early stage stuff, it's going to take a while before that to play out to turn into revenue that has been gone through clinical trials and approved for an actual drug. So I'm not saying it doesn't help their long term. Matter of fact, I thought you were actually talking about Prometheus. Like they bought another company called Prometheus Biotech, that for $9 billion. That company does immunotherapies, but it has no sales. So they spent $9 billion in a company with no sales because same thing. They're buying some things that they think will play out well in a very long-term future for oncology. But it's not generating any revenue in the medium term. So if you're an analyst, like think about discounting cash flows. If the cash flows are coming 10 years from now, and that's when they're going to start, I'm not going to put a lot of value on that today.
So I was so shocked at the price. Like 22 billion is so huge.
Well, again, the price is saying that there is some long-term value, but in terms of how much money they're making now, the market is still putting their PE as if they generate more cash flow now than the long term when you throw discounting into fact. That's why the PE is lower. Whereas Lilly is generating their less cash flow now than in the future, and they just have more early stage. That's why their PE is higher. That's what's happening in the PEs. So it's going back to, now we got to explain this. All right, once we laid the groundwork for understanding this, right, what do we say about Merck today? Why is Merck, their PE, 11.94, so we got to match this. So let me use the solver here. Seek. So I'm going to set their PE now to 11.94 by solving for a G why does Merck have a negative G of 3%? Well, I just gave you the reason, right? The reason why Merck is trading at a discount to Lilly, who has a PE of 32, is because even though Lilly has a higher spread, 75% ROE against a 7.6% cost of capital, is still a lot better than Merck's 40% ROE against, it says 6, I thought it was higher than that. Can I adjust the WACC? Should be 7.1. This should be 7.1. And sorry, I forgot to change that before I did the solver. Tools, where's CalSeek again? Why is it negative 1.6? But the whole idea is Lilly, with the higher spread, has the 5% growth, 4.72% growth. Merck, with a very high spread, they got a 33-point spread, is seeing their growth fall 1.6% a year. And so that's why they're going to be trading at a discount, right? Even though Lilly has a slightly higher cost of equity, it still is way offsetting that by that very high G. Because remember, 2%, 3%, 4% doesn't sound like a lot of growth, but when you compound that forever, 2% versus 4% gets really, really big. Okay? And so that's the point. Like Lilly is compounding that high spread for a very long period of time at 5%. Merck is compounding at their 33% spread to shrink 1.6% every year. That's not going to be as valuable. And that's why they're trading at a discount. Okay? And what you'll see is this typically plays out when you go to the EV to EBITs. Usually the EV to EBITs thematically are very similar to what you're going to see in the PE multiples, right? So what you're going to see, the same thing happened, is if you're trying to explain why does Merck trade at a discount for EV to EBIT to, at the time, they're 12.1, Lilly was 30.5, it's the same concept, right? Lilly had a little bit higher spread, 44% ROIC against a 7% WACC. Merck had 35% ROIC against a 5.7% WACC. Merck had a slightly higher tax rate, which did hurt their multiple, but same concept. They were expected to have an operating performance negative 1.4% G. Lilly was supposed to have a 4.9% G. So high growth, high spread, much higher multiple, right? Low growth or negative growth, even high spread, lower multiple. That should play out with the math. That's what we saw in the marketplace. All right, so let's talk about more difficult companies to value, and then we'll do another practice here in the class. Let's try Ford. Okay. So let's say I want to do Ford. I'm just going to throw them in this middle column, just because I happen to have a spreadsheet open. Not that I'm comparing Ford to Merck, but let's say I wanted to do Ford. All right, let's go to Ford today. F. From a WACC standpoint, cost of equity for Ford today is 12.5%. Go to EEO. Second forward year earnings for Ford, $7 billion, 7027. And if I use the next 4 years as a proxy for the long-term return on equity, 15%. So here's the point. With no growth, that would tell me my PE's 8. Right? Now today, what's the forward PE of Ford? It's 6, 5.99. So how do I get the key value drivers to make my PE 6, not 8? So one way I can do it is same concept as Merck. I could solve for a G. That number doesn't look right. So it's not that weird number. So let's put negative 5% in here. Let's put negative 10% in here. Let's put negative 20% in here. Now, just as an FYI, one of the team presentations on Monday put negative 20% in for their G, and I hammered them on their presentation grade because I said, there's no way this company is going bankrupt in 5 years. Like, it just doesn't make any sense given the data that you presented. It's impossible, and I think even this case is Ford. Nobody expects Ford to go away, and so negative 20% G compounded every year starting this year just doesn't make sense. Because even if you look at this EEO, like, they're growing. They're going from 148 billion to 172 billion. They're profitable. Even with the latest union contract, they're still going to make money. So putting in a giant negative G to make that PE work defies logic. Yet they're trading at 6 times earnings today. Why? What explains that? I can't explain it with a negative G. I'm not saying that the future doesn't look worse than the present. That's essentially what that PE is telling me, right? And in a way, it's kind of like Merck, but it's not like Merck, because they're not going from a position of really high value and going to a position of relatively slightly lower value. Ford is actually, they're trading at 6 times earnings. So what is the market saying about Ford? How do we solve this? How do we come up with a PE of 6 in a logical, explainable way? And we got 3 numbers to do it with. So we can say Bloomberg's WACC is wrong, crank that WACC up. That's one way to do it. I don't think that's the answer. So we're going to change growth or we got to change return. We started to change growth and we started to have to get really, really gigantic negative growths, which conceptually, okay, I know they're not going to do as well in the future, but like they're not going away. So I can't change my growth and I can't change my cost of equity. What's my third option? Change the return. So the point is, whether I agree with it or not, how do you get to a 6 times multiple, 6 times PE, which is very low? They're saying the entire company of Ford is worth the next 6 years worth of earnings. That's not that much. Why do they not put a lot of value to Ford? And I said, if you think through this logically, look at what they're showing. Ford's growing, if I switch these percentages, 5%, 2%, then maybe negative 2%. It's not going away. So they got low growth. It's not negative 20% G, but let's just say it's 1% G or 2% G. Okay. Problem is, even if I give them some little growth, little negligible growth over time, I can't get to a 6 times PE unless I do what? That's Ford. That is the more likely explanation for Ford. What the market is pricing Ford at today Again, whether I agree with it or not is not what matters here. What matters is how do I make the math work? What's gonna make the math work in a more reasonable way is Ford's gonna have very low growth, but they're gonna have a really negative spread. That's the way the market's pricing Ford for the long term. Next 4 years, sure, they're getting a return in equity, but that's not the way they're pricing them today. They're not pricing them as if that return in equity is gonna continue. They're pricing them as if that return in equity is gonna collapse. So if we were doing an EIC on Ford, I would be willing to bet that when you guys got to the section about competitive advantage, you'd say it sucks. They don't have competitive advantage anymore. There's nothing about Ford long-term that's gonna show advantage into the future. And their returns are probably gonna underperform the market. That's the way they're being priced today, right? And you can disagree with that. You can say, no, I love my F-150. That F-150, they're gonna have to pry it out of my cold dead hand. Like, I'm gonna keep buying those. And I don't like electric vehicles. I like gas-powered trucks. They're a dying breed, okay? It's not where the market's going. That's the way the market's pricing this. And so that's the problem. Ford, the big truck company in the electric world, probably not gonna be as successful, and that's the problem. And I think that's the way they're being priced. And by the way, their Mustang's not being a big hit. That E-Mustang thing, weird looking car. Nobody's buying it. But regardless, taking all the commentary aside, they're being priced as if they have a negative spread. That's what explains it. It's not the negative G, it's the negative spread. And that's why you know the math at this point. The key, and this is part of what I'm trying to illustrate in this class, is just because you know the math, what matters as much is what you put into the equation and why you're putting it in. And plugging and chugging doesn't always work. 80% of the time, most of the companies, plug and chugging works pretty standard, pretty explainable. There's the 20%. That's the issue. How do we handle the exceptions? Ford's an exception. In your assignment, what's your other exception? You came up to me before class, and you said you're trying to do homework 11, and one of the companies didn't make sense. What company was that? What company were you having trouble with your homework?
PVH.
And why were you having trouble with PVH?
Here's the spread.
Because PVH is ROE, what number were you using approximately?
I just changed it.
Before you changed it? Was it like 13 point something percent? And what was their cost of capital, cost of equity?
12.9.
So they had a slight positive spread, but they had a relatively low PE. And so the question is, how do you take a company with a slight positive spread and start lowering its value, lowering its multiple, right? And that's what you were struggling with, because what you said is I tried to put in some really weird negative growth rate and I was having trouble getting there. And that's the same thing as Ford. So I think what the market is telling you about PVH is not that their growth is going to fall off the table, it's that they're really worried about PVH's spread long term. And so even the next few years' spread does not represent the way they're being priced as a perpetuity DCF, as opposed to even the next 4 years. So that's the point. What I told you to do as a process is I said, look at the next 4 years and let's assume, does that equal the long term? If the next 4 years doesn't equal the long term, you can't use the next 4 years as the long term. Now, in this case, how do you know? Your clue is the answer. When you see a low multiple, the only way you get to a low multiple is low growth, low spread. When you see a high multiple, the way you get to a high multiple is high growth, high spread. So I'm telling you, if the market is putting a low multiple on a company, even before you try to back in to explain it, they're essentially telling you, I don't see a lot of growth and return in this company. And if they have any meager growth, the way they get to the low multiple is it means it's going to be a terrible spread. They're just investing way too much and getting low returns for this growth, and I don't think it's going to create a lot of value, so I'm not going to price them accordingly. That's Ford. I bet that's what's happening at PVH. I'm not going to say it definitively because you guys still have not done that assignment yet, but I bet if you do your research on PVH, you're going to see all sorts of competitive challenges with them compared to their peers. Does this make any sense to anybody? Questions? All right, so you guys practice. So before we go today, let's just do 3 quick companies. Let's put the data in. Let's make sure we get the numbers right. And then let's try and do a quick walkthrough of the analysis. All right, 3 companies, or 3 that were actually presented last week, or on Monday, right? I want to do Nike, Lululemon, and Adidas. Nike, Lululemon, Adidas. Let's do a quick multiple analysis on them. Let's talk about how the data needs to go in there for all three multiples, and then let's try to explain it. That'll be our practice for class today. Nike, Lululemon, Adidas. Let me give you 10 or 15 minutes to start getting your templates together. Not for a grade. There's a lot of people in this room. Collaborate. You're getting the data out of Bloomberg. I'm talking about relative, but I'm also telling absolute. Like if you see a PE of like 6 or 8, that's saying the entire company is worth 6 times next year's earnings. That's just low. But what I'm also saying is if your peers are trading at like 20 or 30 and you're trading at 10, like there's a reason you're trading at a much lower PE. So it's got to be much lower growth or much lower spread. Something that actually says, because that's our explanation of why we hire, the opposite is true about why it has to be relatively lower.
So I was looking at the assignment for the next homework, and we just need the 6 screenshots of the 3 WAC screenshots and the 3 EO screenshots. But when I was taking notes when you were talking about it, we need the guidance for the tax rate and the.
Well, you need to figure out what the
ROIC.
tax rate is, the guidance and ROIC.
You don't need screenshots for them?
You don't need screenshots, but you got to justify it. Now you want to put the screenshots in, that's great.
Okay.
But you still have to come up with how you got from the data and explain that.